Welcome to the Deep Dive, where we take complex earnings calls, market research, and analyst notes and turn them into clear, distilled insights. Today, we are deep diving into the Q3 2025 earnings call from Century Aluminum, symbol CENX. And this was an absolutely unique quarter. It was defined by a headline earnings miss so wide it just screamed disaster. Yet the market reacted by screaming buy, sending the stock up 14% overnight.
That tension is exactly why we need to dig into this one. It's so interesting. We have to look past the rear view mirror of the financial statements and really understand the powerful strategic narrative that Century Aluminum is selling. Our mission today is to extract those core insights that convince, some very sophisticated investors that the forward-looking strategy, a strategy backed by federal policy and massive capacity restarts, completely dwarfed the short-term operational hiccups.
Let's face facts first, though. The Q3 numbers on their own were tough. GAAP EPS landed at just 15 cents. That was a devastating 64-cent miss against the Zacks consensus of 79 cents.
It was a massive miss. There's just no question about it. And even if you look at the adjusted numbers, the ones that strip out the one-time items, adjusted EPS was 56 cents, still missed the street's expectation by 30 cents.
Wow.
And revenue just confirmed the problem. It missed consensus by nearly 5%, coming in at $632.2 million. And crucially, you could see the operational issues right there in the volumes. Primary aluminum shipments actually fell sequentially to just under 163,000 tons.
So lower revenue, a big earnings miss, and less product shipped. Those are all the classic signals for a stock to tank.
Yeah.
How did Century manage to turn that into a 14% rally?
Because the market cares more about the rate of change than the absolute number. It really does. You have to look at profitability, not just volume. Adjusted EBITDA, it rose significantly from $74.3 million in Q2 all the way up to $101.1 million in Q3. That sequential jump over $26 million, that was the first sign of this powerful underlying momentum. And that momentum was driven almost entirely by pricing power, which, the market clearly believes will continue to accelerate. The message was basically, we accept the operational speed bumps because the structural tailwinds are overpowering everything else.
Okay, let's unpack that Q3 pricing story, because it had to be phenomenal to overcome that volume drop, a drop which we should say was caused by instability in Mount Holly and an equipment failure in Iceland. So what was the absolute most important factor offsetting all that negativity?
It was the regional premium, the realized Midwest premium, or MP. This is the key metric showing the tightness in the U.S. market. It jumped an astounding $575 per metric ton sequentially to hit $14.25 per metric ton.
$575.
An enormous increase. And that, combined with slightly higher LME spot pricing, was responsible for the entire sequential EBITDA improvement.
That is immense pricing power. But I do have to challenge this narrative a little bit. Management is really relying on a structurally high Midwest premium. Is this sustainable, or is it just, tariff-driven volatility?
That is the right question to ask, 100%. If the price were only tariff-driven, it might be fleeting. But the analysis suggests the premium is sticky because the U.S. structural aluminum deficit is huge.
How huge?
About 4 million metric tons annually. The 50% import tariffs from June certainly create a protective shield, but high premiums are also supported by logistical constraints and just a lack of domestic smelting capacity. This is why management is so bullish. They see this as a sustained policy-backed structural environment.
And the strength of that Q3 premium, it sets the stage perfectly for the Q4 guidance, which is truly where the inflection point lies.
Absolutely. Management guided for Q4 adjusted EBITDA to jump dramatically to a range of $170 to $180 million.
So from about 101 in Q3 to potentially 180 in Q4.
Right. Think about that. That's a 70% quarter-over-quarter leap. This is what caused the stock to rally. It was all about that guide.
And what were the assumptions supporting this guidance?
They're very favorable, but they reflect that market tightness we were talking about. A realized LME around $27.05 per metric ton, and a realized Midwest premium around $17.75 per metric ton. But here's the nugget that really fueled investor excitement. Management openly stated that if they updated this guidance using current spot prices at the time of the call, the projected Q4 EBITDA could hit $220 million.
Wow.
So that suggests there's still potential upside embedded in the first half of 2026 if these macro conditions hold.
Okay, before we move to the major projects, we should probably touch on costs. The pricing tailwinds were massive, but they were partially countered by rising input costs, right?
Correct. The two main drags on performance were higher power costs in the U.S. due to warmer weather spiking demand. And then there are certain power contracts in Iceland that are structured to link the cost of power directly to the spot LME price.
So as the price of aluminum goes up,
Their cost of operating the Icelandic facility also rises. That was a $9 million headwind to profitability in Q3 alone.
let's pivot to the policy and projects section because this really provides the foundational reasons for that long-term bullish outlook. The Imhali restart is the nearest and I think the clearest catalyst. What are the concrete steps that de-risk this project?
The biggest de-risking event was finalizing the critical power agreement. That was with Santee Cooper, and it runs through 2031. Aluminum production is incredibly power intensive, so having that long-term contract locked in means they can confidently plan the restart of over 50,000 metric tons per year of incremental capacity.
And the timeline.
The ramp-up is scheduled to start early in Q2 2026 and should be fully complete by the end of June 2026.
And what is the payout for that execution? What does it translate to?
The math here is incredibly compelling. It's one reason the market loves this story so much. The total project cost is roughly $50 million. Once that capacity is fully running, management projects an added $25 million in quarterly adjusted EBITDA contribution.
$25 million a quarter on a $50 million investment.
Exactly. If you look at the return on invested capital, it's a profoundly attractive ROI that should start hitting the run rate in Q3 2026.
That is compelling. Now, what about the immediate setback, the Grundartangi outage in Iceland? An equipment failure shut down a whole pot line, creating a $30 million headwind in Q4 alone. How does management mitigate such a significant hit? Or is that just unavoidable short-term damage?
Management's key saving grace here is insurance. They expect the financial impact to be fully covered by property and business interruption insurance.
So even though the timeline is long, maybe 11 and 12 months for a full replacement,
the financial hit should be manageable. There's a $15 million deductible, but the insurance proceeds should essentially offset the monetary loss. It means the hit is more to volume than to long-term profitability.
Okay, so Imhali provides near-term growth, insurance mitigates the Grundartangi loss. Now let's zoom out to the long-term vision. The Greenfield Smelter Project. Planning the first new U.S. primary aluminum smelter in half a century is an immense undertaking.
It is massive. This project, targeting the Mississippi or Ohio River basins, aims to essentially double the size of the existing U.S. primary aluminum industry. And the policy backing is clear. The project is supported by up to $500 million in U.S. Department of Energy grant funding.
$500 million.
That level of government support just underscores the political imperative to reduce that 4 million ton deficit we mentioned.
But this project has a 4 to 6 year timeline. Given the massive capital requirements and, the permitting challenges facing any new large industrial project today, what are the primary risks management acknowledged?
They were pretty realistic about it. The timeline is long and the scale necessitates a partnership. Management sees a joint venture as the most likely path forward to spread that immense capital load.
And the risks?
The major risks are exactly what you highlighted: securing long-term, reliable, and competitively priced power. And then navigating the permitting process, which is historically lengthy and often faces local opposition, even with federal backing. It's an aspirational project that really ties their future to continued strong government support.
Shifting gears to the money that funds all this, the balance sheet. Liquidity is critical for funding large projects and enabling capital return.
And liquidity stood strong at $488.2 million at quarter end. A huge contributing factor here was the receipt of a $75 million IRA Section 45X tax credit refund in October.
Right, the 45X Advanced Manufacturing Production Credit.
It's vital for Century. It essentially pays them cash back for producing metal domestically, turning production into a predictable, non-dilutive cash flow stream.
And those tax credits are not fully realized yet, correct? There's more to come.
Precisely. They still had $220 million in 45X tax credit receivables outstanding at the end of Q3. This is future cash flow that is essentially de-risking their balance sheet transformation. Their net debt right now is around $475 million, but management is aggressively targeting two specific goals: $250 to $300 million in liquidity and getting net debt down to $300 million.
When do they expect to hit that net debt target, and what's the plan once they do?
Given the massive cash generation power suggested by that Q4 guidance and the flow of those 45X credits, management expects to hit that $300 million net debt target quite early in 2026.
And after that?
Once the targets are met and sustaining CapEx is covered, the top priority for returning excess cash is overwhelmingly share repurchases. They cited listening to strong shareholder feedback, confirming that buybacks should start in 2026. This is a critical pivot in their story, from maximizing leverage to maximizing shareholder return.
That narrative shift certainly explains the market enthusiasm. But we do have to address the external sentiment divergence. The stock rallied 14%. Its IBD relative strength rating shot up to 91, signaling top decile performance. Yet Zacks still maintained a strong sell, ranking at number 5. What does that divergence tell you?
It tells you that the tension between macro fundamentals and execution risk is very, very real. The analysts maintaining a sell are likely worried about the operational wobbles we saw, the instability at Mount Holly, and the Grundartangi failure. They're worried about whether management can actually execute on that aggressive restart timeline. The market, however, believes the policy-backed pricing environment is so rich it will solve all execution sins.
And we also saw some institutional action in response to the huge rally the stock has seen since June.
We did. Glencore, the massive institutional holder, trimmed its stake from 43% down to 33% after the substantial rally.
Profit-taking.
Classic profit-taking after a massive move. Essentially, booking gains while still maintaining a significant position. It signals that while they saw enough value to take some risk off the table, they still have confidence in the overall management and the structural direction of the company.
All right, let's move into the segment dedicated to our experienced investor audience.
And just a quick reminder for everyone listening, the following segment is for informational purposes only.
Right.
We're discussing potential trade structures and market dynamics, not providing registered financial advice.
This is not financial advice segment. We are pitching a synthetic long position that centers on the key operational catalyst expected in the middle of 2026.
Okay, so the thesis here is this. The Q4 guidance is priced in. The next major event the market needs to absorb is the full run rate contribution from the Mount Holly restart. That begins hitting in Q2, Q3 2026, delivering that compelling $25 million per quarter in incremental EBITDA. Furthermore, the market needs to fully credit the company for resolving its net debt target early in 2026 due to the incoming 45X tax credit cash. And that resolution paves the way for the promised share repurchase program.
Okay, and how would we structure a trade to capitalize on these mid-2026 catalysts while using the current market dynamics?
We need to use the elevated implied volatility. It's high around 71% because the market is pricing in significant execution risk on both Mount Holly and the Grundartangi repair. We are betting that management successfully executes both, which would resolve that risk premium.
So what's the strategy?
The strategy is to initiate a short put-long call spread. That makes it a synthetic long position, and we'd target the January 2027 expiration. We recommend centering the trade around the $40 strike.
The expectation being that successful execution on the Mount Holly timeline and the start of buybacks will force a significant multiple re-rating.
Exactly. When the company successfully hits that mid-2026 operational deadline, clears its debt targets, and initiates the buybacks, we project the stock could push comfortably into the mid-40s. You're capitalizing on the removal of leverage and operational uncertainty that has, long dogged the stock. It's a bet that policy and successful execution dominate cyclical concerns.
To bring it all back home, Century Aluminum's Q3 was a masterclass in shifting investor focus. They reported a massive miss, but convinced the market the story was entirely about policy-backed growth and de-risked capacity addition.
Absolutely. The massive Q4 EBITDA guidance, securing the long-term power contract for Mount Holly, and the vision for the Greenfield smelter all tied directly to U.S. government policy are the cornerstones of this story. They are not just selling aluminum, they are selling a vision of becoming a structurally critical, policy-protected domestic producer.
That structural optimism is tied so tightly to the permanence of policy. So given management's aggressive stance that the aluminum tariffs are working and will remain indefinitely, what happens if external factors change? Specifically, what happens if global aluminum inventories start to recover faster than expected, potentially neutralizing or significantly reducing that very high Midwest premium that is currently driving all these profits? What risks are hidden in this policy-dependent structural optimism, and how fast would the narrative unravel if that 1775 premium suddenly fell back toward its historical average? That's the crucial variable for you to mull over.